Quick question. Can you write off your car if you're self-employed? My contractor buddy Mike just bought a $92,000 truck, and he was bragging to me that the government paid for half of it. Now, if you know my accountant Jeff, he would have a heart attack hearing something like that. Writing off your car for business is one of those tax topics where everybody thinks they're an expert. Really, everyone from your brother-in-law to that guy at the gym tries to give you advice. But there's what people think, and then there's what the IRS says is okay. And guess whose opinion matters? So today, we're getting into what really counts as a vehicle write-off. Because if you do it right, it's one of the best tax deductions out there. But if you mess it up, you're asking for an audit faster than you can say Ford F-150. Let's break it down. Meet Mike, contractor, truck guy, forearms like Popeye, and he has a heart of gold. You know, he's the kind of guy who shows up with donuts when your pipes break, and he makes the repair seem easy. So last year, Mike calls me up. He's absolutely hyped. He's bouncing off the walls excited because he finally bought that new Ram 3500, and it had all the bells and whistles. But it cost $92,000. Still, we're talking chrome everything, leather seats. It's the kind of truck that makes other truck guys jealous. Mike says to me, "Rich, it's a full write-off, full section 179. The government paid for half this beast." Mike had been driving this old beater the past few years, so I was excited for him to get a new truck. He's a good dude. He always shows up on time. You never have to question the work he does. But when it comes to taxes, I had some serious questions about his purchase. Did he track his mileage every single trip? Was this new truck 100% business use? No personal driving at all? Did he put it into service before year end? Did he document everything in his business's name? Basically, I'm thinking, Mike, you can't just yell write off like it's a magic spell and expect the IRS to make your taxes vanish in a puff of smoke. Trust me, no matter how hard you try and want it to be true, the IRS is surprisingly resistant to sorcery. All jokes aside, here's the thing about vehicle deductions that nobody talks about. It's not just saving on taxes. It's about building a business that actually makes financial sense. Mike's $92,000 truck payment costs him thousands every month, deduction or no deduction. That's cash flow that could be building his business instead of just impressing other people. Here's how car deductions actually work if you want to do it by the book. If you're self-employed, you've got two options for deducting vehicle expenses. The first is called the standard mileage method. Simple, straightforward, less paperwork. The other way is the actual expense method. That's the one where Section 179 comes into play. More complex, potentially bigger deduction, way more documentation. Let's break them down so you understand the difference. My accountant Jeff's executive assistant is named Emma. She drives a 2021 Toyota Prius. Nothing fancy. Jeff even teases her that it looks like an electric lunchbox on wheels. But for a vehicle like her Prius, I love the standard mileage method. At the time of this recording, the IRS standard mileage rate is 70 cents per mile. If she drives 10,000 business miles, that's a $7,000 tax deduction. Clean, simple, no gas receipts, no maintenance tracking, just log the miles and she's done. And there are mileage tracking apps that basically help you do this automatically. It only takes about 3 seconds to categorize each trip, and honestly, if you're under 15,000 business miles a year, the standard mileage method is usually the winner in my book. We're talking less headache. It's a solid deduction. But then there's Mike and his beast of a truck. If you guessed he financed it, then you'd be right. His goal was to claim 100% business use. Wants to write off $92,000 in year one. He even slapped a logo on the door thinking that'll definitely make it 100% deductible. When I was telling my accountant about all this, he just said classic Section 179 misuse. Next, Mike will be trying to write off his fishing boat, right? And I just said, yeah, kind of making a joke too. It's kind of like the financial equivalent of wearing socks with sandals to a wedding. It looks bad and everyone notices. So here's how the actual expense method works in real life. You can deduct a percentage of your actual costs We're talking depreciation, gas, insurance, repairs, loans, the whole nine, based on how much you use the vehicle for business. Yes, there is a tax code called Section 179 that lets you write off the depreciation portion completely up front in the first year, but only if the vehicle is used more than 50% for business, and you've got to prove it. You've got to place it in service during the tax year, documented, dated, signed, and the vehicle qualifies. It's got to weigh over 6,000 pounds. So yes, most big trucks usually qualify. But here's where people mess up all the time, and I see it constantly. If Mike only used the truck 60% for business, he can only write off 60% of the costs. That includes the Section 179 part. The IRS doesn't care about the fact that the truck looks cool at job sites. They care about the numbers, the documentation, the truth. You need the proof. So many people get this wrong. They'll buy these massive vehicles thinking they're getting this huge tax break and then realize they don't have and can't prove the bona fide business use. But let's say you're going to try and write off your car. I suggest doing these 3 things first. You got to be smart here and know the rules. First, log your miles, every single one. Start of the day, end of the day. Commuting doesn't count, by the way. That's personal. Use a mileage tracking app or even a notebook in the car. No matter what, just be consistent and detailed. Number 2, separate business use versus personal use. This is crucial. You can't be out there writing off your family road trip to Disney because you took one phone call while waiting in line for Space Mountain. And 3, be ready to prove it. This means keeping records of when you bought the vehicle, odometer readings, your mileage from the start and end of the whole year, and even your business purpose for each trip. For example, meeting with the Johnsons about the kitchen remodel. That's good. Just jotting down work stuff, not so much. And that's because guess who's checking if you get audited? The IRS. And guess who's digging through all your scattered receipts? It's either you or your accountant, but no matter who's trying to save you in that moment, nothing's going to make you happier than already having organized tax documents and mileage records. Let's use some real numbers here. Let's say contractor Mike drove 20,000 miles last year. Let's say 70% were legitimate business miles. If he opts for the actual expense method, his total truck costs would be about $25,000 between depreciation, gas, insurance, repairs, and the interest on his loan. 70% of that, that's $17,500. Not a bad deduction. But Emma, for her executive assistant business, she drives about 10,000 miles per year. It's all business, all documented. She uses the standard mileage method. So 10,000 times 70 cents, that's a $7,000 deduction. So yeah, Mike's tax deduction is bigger, and that's what he said too. But he's also spending more, way more. And if he ever gets audited and can't prove that 70% business use, that's a problem. Like start selling your stuff to pay for the penalties kind of problem. And I never want anyone to have a why didn't I listen to Rich kind of problem. So I ended up chatting with Mike. He was at Home Depot a couple months after. We talked all this through. He's keeping a mileage log now, and he even keeps like voice notes, talk to text style on his phone when he's driving. He gets it now. The deduction's only worth it if you're doing it right. Otherwise, you're just asking for trouble down the road. Can you write off your car for business? Yes, but do it right. Do it smart. Do it legally. I've seen business owners save thousands doing this correctly. I've also seen it cost thousands doing it wrong. The difference usually comes down to this part. The winners plan their vehicle strategy before making a purchase, not after. So whether you're a Prius person like Emma or a Ram rebel like Mike, you've got options. But remember, the IRS doesn't care about your vibes or your image, just your records and documentation. Oh, and I dropped links down below in the description of this video to some of the best mileage tracking apps, the credit cards I like to use for gas, and some bookkeeping tools, so feel free to check those out. And if you're not sure which of the 2 methods is right for you, leave a comment on this video. I read every single one. All right, as always, I'm Rich, and until next time.